You can do anything that the tax law says, but you just have to make sure that you have the right facts in place and the right documentation and the right pieces aligned to be able to take that position and be comfortable with it.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey guys, welcome to another episode of Wealth Strategy Secrets of the Ultra Wealthy. I'm your host, Dave Wolcott, and today we're tackling one of the most critical aspects of building and protecting your wealth, tax strategy. Taxes are your single largest expense, yet many entrepreneurs and investors struggle to unlock the opportunities that smart planning can bring. That's where today's guest comes in. Joining us is Aaron Hofrichter, CPA, real estate investor, and business owner who not only understands tax strategy, but also walks the walk by applying these principles in his own life. Aaron's unique journey spans from working at a Big Four accounting firm to building his own real estate portfolio, and now helping clients leverage advanced tax strategies to reduce their tax burden, grow their wealth, and achieve true financial freedom. In this episode, Aaron shares the key differences between tax preparers and strategic tax planners and why you need the latter, little-known tax strategies for entrepreneurs and W-2 earners that could save you tens of thousands of dollars annually, and how to align your wealth-building strategy with your tax strategy for exponential growth. And finally, the critical importance of education, documentation, and proactive planning. If you think someone can benefit from this wisdom, please share it and be sure to subscribe to the show. And without further ado, Aaron, welcome to the show.
Hey, thank you. Appreciate it. I'm really looking forward to having the conversation, and thank you for having me on.
Yeah, really great to have you on the show today, Aaron. I know the audience is going to get a ton of value out of this one. And what I find so interesting about your journey is, not only are you a CPA who really understands entrepreneurs and business owners and really some great tax strategies to really support that, but you walk the walk yourself, right? As a real estate investor, investing in alternative assets and everything. So I think you have a unique perspective there on really knowing what it's like, right? And also as a business owner as well. So why don't we start off there and let's talk about your origin story a little bit. And, did it actually start with real estate investing or did you start with tax? What was the inception for you?
Yeah, no, it's like anything else. It's a journey, right? Everything kind of meanders and goes, and you make different decisions and different moves throughout time. So, really, my origin story, when I started out of college, I started a big international CPA firm working in the tax department down there. And it was the first time that I really thought to myself that the 9-to-5 grind working for somebody else wasn't necessarily the right path to go down or what I wanted to do. So worked there for probably 3-4 years. I actually left, started my own real estate development company, fixing, flipping, buying properties, fixing them up, reselling them. This was way before HGTV, fix and flip kind of show. So if I would have been smarter, I might have just stayed and, started my own TV show at the same time too, but I didn't. So that was probably leading up to the 07, 08, no doc loans. Obviously that was too good to be true. So once that no doc loan situation went away, then I kind of dabbled in real estate. I was a real estate agent and a financial advisor, and none of that really took or stuck. So found myself back in public accounting. So back in public accounting, worked for some regional CPA firms. And then after that, after the regional CPA firms, I made another move over to work for a real estate developer. And I was their controller, CFO for about 7 years. Again, back in the 9-to-5 grind, wasn't too happy with that. So made another move to say, okay, you know what? I like real estate. I want to be more involved in real estate. So I started developing my own real rental portfolio. Problem was I didn't have a whole lot of money, and I didn't really understand and know creative financing now like I did, then like I did now. So, I found some partners that I could work with and work through to go out, buy properties, fix them up, rehab them, refinance. So I did the BRRRR technique for a long time. And that was while I was still working. And then I decided that, I want to go a little bit further down this path, right? And so I started educating myself and finding more. And I found a cash flow quadrant from Kiyosaki. And that was really the book that kind of opened up my eyes and thought, all right, how do you really build wealth and how do you really grow over time? So I dug really, really deep into that book, then started educating myself a little bit more. And then I've dug into that universe, found his CPA, and then started read his book, realized that there was another path I could go down even more so that could combine the entrepreneurial side, the tax experience, the real estate experience, all those different pieces. And so then I bought a CPA firm and then started going down the CPA track on my own. In the last 5 years, I've really been focused on just tax advisory, tax strategy, primarily for real estate clients because it's a lot of my background. So it's kind of been, it's been an evolution. It's been a journey all the way through. Like I said, each step is, another move or another change and going in a different direction.
Yeah, it's interesting. I took the purple pill as well. And, cash flow quadrant was such an eye opener. And if any of the listeners haven't read that, that's, 101 must read, in terms of this world and really understanding, becoming a business owner and investor is actually not only the best place to operate from where you can really scale your wealth, but it's also the least amount you're going to pay in taxes, right? The least opportunity, is what I figured out, right? And knowing that taxes are your number one biggest expense, no matter what you do, how can you actually reduce those to really optimize those and really understanding things. But I'd love for you to frame, Aaron, for the audience. A lot of people are new in the alternative investing world or really understanding the possibilities of tax. And I always wish it was explained to me, how does the industry actually work, right? And it took me years and years and firing many different CPAs to figure out there's something called, a strategic tax planner, and then there's someone called a tax preparer, which are two totally different things. But to me, on the surface, it seems like, 99% of the industry are actually tax preparers.
Yeah, no, I would completely agree with that. And that's probably the one thing that I realized when I started really diving in and really getting deep into the tax advisory, tax strategy world, was that everybody that was coming in because our process really does start with its strategy, right? I mean, we don't really hey, we'll just do your tax return, because I don't enjoy it as much. I think that's why I was in and out of public accounting so much, because the traditional firms that I worked for were very much that. Like, we just prepare the tax return, we give you back, whatever information you need, call us if you have any questions, right? And I think that's, like you said, 99% of the industry. What I realized that, going forward is that the most impact can be made by starting not only with a tax strategy, but also by developing the wealth strategy first. And so by having that wealth strategy first, you understand and know what you're invested in, how do you earn your money, what kind of opportunities do you have that are out there, because from that, we can take that information and then develop the tax strategy associated with that, because how you earn money is the number one thing that we can mitigate from a tax perspective, and knowing how we can match those different things together and, really develop the game plan. But in order to be able to develop the game plan, have to have a really good focus and understanding of, how are you going to build your wealth during that time?
Yeah, makes sense. So if you had a new client come on board, what does that typically look like? Is there like kind of a phased approach or series of things that you're kind of looking for in terms of setting that up?
Yeah, absolutely. So, and I think that's probably the most, like I said before, that's the most important piece of it, is really working in the beginning, usually a meeting or two, to develop and get a good understanding of how are they going to build their wealth. Because many people, If you're an entrepreneur, maybe it's your business, right? If you're a real estate investor, maybe it's just growing your rental portfolio. If you're, a W-2 employee, but you have investments on the side, everybody has different scenarios and different situations. So, taking some time in the beginning to really get a good handle and identify what's that main focus in the wealth building strategy going to be, because I believe in what I found, like that also helps you transition over from being an amateur investor to a professional investor too, right? And I think there's a difference between amateur investing and professional investing. That's what I realized even in my own path of going out and finding the real estate and I focused on the BRRRR technique primarily, and what properties would be good opportunities for that from a real estate perspective. So, it's understanding and getting to know that really, really well. And then from there, once you have a good handle and a good understanding, then you can say, okay, real estate professional is an opportunity. So, we're going to use that for tax mitigation, or passive business ownership is your opportunity. So we're going to use, other passive losses, alternatives to be able to match. So I think, trying to understand income matching is probably one of our primary techniques from a tax mitigation standpoint. So a lot of that just comes with, knowledge and talking and developing the plan and the strategy first.
Yeah. Can you give us an example of that income matching?
Absolutely. So, yeah. So let's say, if there's a client that is heavily involved in real estate and they're active in real estate. And so, if we can utilize that real estate professional status for them, then, maybe it's a husband, wife, partner couple. And then, one person's active income can then be offset by the other person's real estate professional status. So, all those different pieces. And then I also have other clients on the other side too, that, they have businesses, they work in the business, but they don't have to work as much in the business because they've already established the people and the processes and the systems inside there, so they can actually be passive inside of their own businesses. So now if you're passive inside of your own business, that's a perfect opportunity to say, all right, this is also a passive activity. And then can we go out and find other passive losses through real estate or syndications or other things along that to be able to even offset your business income, which at one point you thought was active, but might actually be passive. So it's really trying to get to understand the facts, the circumstances, where do you spend your time? Yep.
And Aaron, how do you actually work with your clients, right? So once you set up that strategy just on an annual basis, are you having strategy meetings throughout the year? Do you do any kind of year-end planning things, or what does that typically look like?
Yeah, no. So another thing I've also realized as we've been doing this more and more is that tax planning is not an after the fact scenario. It's always, advanced planning. And advanced planning is what you can do during the year to actually change your facts or your tax situation as you're going through the year. So all of our clients, we're on, whether it's twice a year, quarterly, or some even monthly, meet with all clients at some point during the year to do tax planning. And in that process, it's, reviewing their accounting, because the accounting is kind of the baseline for knowing what you have going on from an income standpoint. Are you making money? Are you losing money? If you are making money, then how much, tax do we have to deal with, and what opportunities do we have to be able to try to mitigate that, right? And if the business is not going well, are there tweaks and changes and things we can do inside the business to be able to improve that also? So, yeah, we're always meeting throughout the year with our clients and making sure that they have a good understanding of what their current year tax situation is, because it's tough, especially with year-end planning. You don't want to get to November and December and say, okay, you have to go buy two rental properties before the end of the year and you have 60 days to do it, right? So it's better to kind of work the plan all the way through the year to make sure that, if you need to buy 3 properties this year, that you need to go buy 3 properties, or, whatever that scenario might be.
Yeah. How do you plan for that for businesses that are, may have some cyclicality to them, or they're seasonal or things like that? So people don't really kind of know where they stand until, say, Q3, Q4.
Yeah, I think a lot of times historical, you can always look back at last year, right? And try to gauge off of last year. And business owners usually have a pretty good handle on what's coming in and what they have in the pipeline, and a pretty good handle on where they think they're going to land and end up at the end of the year. So even if there is some, cyclical nature to it, they can always look at last year, or we can look at last year and say, okay, last year, Q4, you did this. Are you expecting growth? Are you expecting less? Or, just to be able to kind of gauge and game plan as you go through the year.
Yeah, makes sense. One of the other big lessons that I learned over the years as well was really being an active partner with my CPA, and really not, looking to them to say, hey, you have to do everything. You're going to come up with a magic bullet. You're going to come up with all these strategies and things because, number one, you need to understand, right? First of all, like what's possible. And then anytime you're buying an asset, you've got some kind of liquidity event or exit or something, you have to be thinking about taxes, right? Because at the inception, you can actually set it up a particular way. So are there any, trainings or things that you do with your clients to, help on this education side? Because again, I think that's really the source of some of the biggest challenges, right? Especially when it relates to taxes. Most people just think that, hey, this is what I make. This is what my tax preparer said I owe. That's all I have to do it. So how can people be empowered and educated?
Yeah, no, I think education, I think, is the key word, right? And that's a big part of what we do, and constantly educating our clients on the different opportunities and the different pieces that they have, different options or opportunities that they have in play. And then even if it's sending them to other educational sources or other educational coaches or other, consultants or whatever else it is, because I've always said, like, the more the clients know, not only the easier our job is to help them through these things too, but also the more knowledge and information they gain that help them be a better investor and help them be a better business owner and a better, any of those other pieces. So I think the educational piece of it is it's amazing. Between, podcasts such as yours and books and all those things that are out there, there's so much information out there, and there's so many different resources that people can tap into. I think that is another reason why specialty and becoming that professional investor is important too, because then it starts to hone in and focus all the different things that you can learn and learn about, because there's so much information out there that sometimes I think it can be a little bit overwhelming, right? And so if you kind of pick a path or you pick a vein and you focus on that, then I also think that helps the educational experience also.
Yeah. How would you define actually a professional investor?
Somebody that knows exactly what they're looking for, and they can evaluate an investment in under 15 minutes. I think that's all, whether it's a move, whether it's obviously they wouldn't decide a go or no go in 15 minutes, but is this investment worth me taking additional time to do further due diligence and further evaluation of it? Right? And I think that an amateur looks at 100 different things, and each one has its own uniqueness to it that might have a different outcome or cause a different outcome. Whereas in a professional investor, I think they have an understanding of what their goal, they know what what rate of return they're trying to achieve. They know first of all, they know the asset class that they're looking in. Then they know the rate of return that they want to achieve. They want to know how much, how long that their money can be tied up for, and then be able to go from there. So I think it's having that ability to make quick decisions. Yeah,
makes sense. So what I'd like to do now is ask you two different questions, right? So, the same question, but really two versions of it. So rather than giving basically, and I'd like to talk about strategies, and rather than saying, okay, what are kind of the top 3 strategies that you use? How about the top three most unknown strategies that you like to use, maybe that aren't so popular. And then let's use this A for a business owner, entrepreneur. And then B, let's talk about for those folks that are out there that are, W-2 earners.
Yeah, I think probably the biggest one, and we saw this a lot really at the end of this year. I think from a employee standpoint, W-2 income is very hard to fight against, right? So you have to be able to identify, what are ways that we can offset active income. So I think oil and gas is probably the number one go-to when it comes to high W-2 earner that, has a lot of active income that we can't really do much against. I think oil and gas is a really good opportunity out there right now. I think also looking at, if you have a husband-wife scenario, right? Could one be a real estate professional? Could, while the other one has a W-2, if you're building we have quite a few. One, high W-2, other is the real estate professional. So they're the ones that are managing the rental property, finding new properties. So then we can still get the real estate professional status to be able to offset that other active income too. I think those are probably the two primary for W-2 owners. Obviously there's deferral. I'm not a huge fan of deferral. Deferral is obviously kind of our last go-to. For by deferral, I mean qualified plans, deferring to 401ks, that kind of thing. So that's usually our last resort, because deferral is not, you're going to pay tax on it eventually. Rather have immediate tax deduction and immediate tax impact, in the current year.
Hey, it's Dave Wolcott here. Let me ask you something. Are you tired of the same old financial advice that leaves you spinning your wheels? If you're ready to discover the real secrets the ultra wealthy use to build unstoppable wealth, then I've got something just for you. My new book, The Holistic Wealth Strategy, is your ticket to learning the proven strategies that the top 1% don't want you to know. This book isn't just about money. It's about building a life of purpose, freedom, and lasting impact. And I want to give you a free copy. Visit holisticwealthstrategy.com and get yours today. It's time to level up your financial game and create the future you deserve. So let's unpack that, Aaron, because I've been making that case for quite a while, but it's interesting, right? Because I think people have certain belief systems, and we were all taught, right, from this multi-trillion-dollar financial services industry, like our peers, our parents, everyone, put money into these qualified plans, your 401k, your IRA, right? That's the plan, and it took me asking a lot of, really hard questions, including, does it really make sense to defer taxes? Right. And people just talk about that. And especially typically tax preparers, they say, well, we can help you on your taxes if you defer taxes. But as you kind of look into that, and I love this, quote really from like the agricultural community. It's like, I'd rather pay taxes on the seed, rather than the harvest. And it seems like a lot of people just don't understand the impact. They're getting their statements on their 401k, and they're really not understanding the true net, impact of what that's going to be when they go to retire and take out those funds at 59 and a half, what taxes, fees, and inflation, how much that's going to impact those gains. Yeah, no, absolutely so. And I think we're all victims of this, $1 trillion Wall Street industry, right? And I think there's a lot of like you said, I grew up in a blue collar family, right? And it was, go to work, put money into a 401k, save. And that's actually, I guess referring back to part of my journey when I was working at the real estate developer. I ran the 401k plan there. So I was sitting there, I was running my mid 30s. I'm thinking, this is great. Corner office, exactly the industry I want to be in. This is exactly what I want to do. And then I started running the numbers, and I said, all right, well, for the next 35 years, if I really want to retire the way I want to retire, what I need to put into the 401k plan is unachievable. And also it's going to take me 30 years to be able to do that. So that was another light bulb moment that kind of went off that said, you know what, there's got to be a different path and a different way. And that's why the entrepreneurship aspect came into play of, hey, because then you can actually
grow wealth much, much faster if you have control over the investments that you're making. And I think the 401k aspect of it is, put money, into some plan that will build up over time. And then maybe at some point later on, it will pay off for you. Right. And, and you're not to mention, hopefully you're going to retire poorer, right? Because then your tax bracket's going to be lower, and then it's going to be better opportunity for you, as opposed to maybe actually achieving the future lifestyle that you want to be able to achieve. Maybe your tax bracket's higher. So the money that you deferred actually went in at a lower tax bracket than the money that's going to come out of the 401k plan, right? I mean, I think that's probably everybody's goal, is to, have a better lifestyle, to earn more money later on. So theoretically, I mean, you're going to have a higher tax bracket at that point later on. So I think it's definitely, it's the traditional mindset, right? Of this is what we were told, this is what we were taught to do, but there's other paths and there's other opportunities that are out there.
Yeah. I think this is just really such a huge takeaway for folks out there, right? Because if you look, I don't have the numbers off the top of my head, but the amount of money in the US market alone, right, that's in qualified plans and that is subjected to this is massive. So talk to us a little bit about, the numbers as a CPA, right? Just kind of modeling out really some, let's say, real estate and alternative investments, tax efficient type investments, in that kind of scenario over the lifetime of a career, versus this traditional approach that's maybe modeled to the S&P that has, the higher taxes, fees, and inflation.
Yeah, absolutely. So I'm thinking of one client, and specifically if they have, high income, right? So high tax bracket, had acquired a bunch of rental properties over time, didn't understand, didn't know about cost segregation, that was even an opportunity, right? So all, came in, we developed a plan, developed a strategy, went in and decided, did cost segregation studies. And we were able to offset the majority of their income that they had earned during the year. So, I mean, I think it was over 7 figures of income that we could offset in that first year to be able to. So if you talk about 7 figures of income and paying zero tax during the year, if you took that $230,000, $300,000 of tax that would have been paid to the government from in taxes, and just use that to buy another rental property that produces more cash flow, that new property then can have a cost seg study, which then we can offset income. So you almost get this repeating building cycle upon itself that just perpetually grows and grows and grows, as long as you're doing the right activities that are inside of there.
Yeah, no, it's really spot on, right? I mean, that is really essentially the formula. It's really quite so simple, which is, buying tangible assets that produce passive income, reduce your taxes, and have equity growth to them. And you repeat the cycle so that you're constantly buying assets because you have to keep offsetting the taxes, right? And then if you keep doing that, you can truly build legacy wealth. And then actually you'll get a stepped up basis on most of the assets, right, when you pass. But, any kind of thoughts to that? Because, Kiyosaki talks about that model. Some people kind of talk about that model. This is what I've seen family offices, ultra high net worth do extremely well. But yet it still seems to be, deceptive or kind of opaque for people to kind of, figure this out. Maybe it's the discipline and the psychology of it.
Yeah, and I think the discipline and the psychology is probably the biggest piece of it, right? Because to your point, I mean, it's a very simple concept, right? But there's many times that you have a very simple concept, but it's the execution of it that doesn't always happen, right? And so it's the execution of the plan is what actually brings the plan to fruition, right? So that's why developing that strategy and that game plan in the beginning and knowing what that future goal is going to be is so important, because then if you have that future vision and you have that goal and that game plan, then you know what you need to do from an execution standpoint, and not just from a 5 year, but a 1 year to a quarter to a month to what do I need to do today to be able to actually execute on that. And the execution part, I think, is is probably where a lot of people get tripped up.
Yeah. Yeah. No, you have to evaluate totally alternatively. And again, to me, the thing that always really brings it home is just, model out the scenario and just run this, run the numbers yourself. A lot of this isn't really complicated math, but, you can make some assumptions, you can do some projections and kind of see where it ends up. But so many people are just chasing yield. I can get 8% here, I can get 10% there or 15% there. That must be a great deal, right? But you have to look at the net impact, right? Because it's really about what we keep, not what we make. And when you throw in, if you have a great tax strategy, just think about if you can reduce your taxes 10, 20, 30%, and that's compounding over time on top of, the new asset class that you're getting. This is how we're seeing outsized returns, for clients.
Yeah, no, absolutely. So, and taxes is one of your greatest expenses, right? So, it's the most immediate way to put cash back in your pocket to be able to go out and make that additional investment, right? And so I'll give you a good example. When I was with the real estate developer, we had big projects, and there's tax credits that are associated with those big projects, right? And so some of the tax credits are a dollar for dollar reduction, right? So it's not a deduction, because a deduction just reduces the overall income, whereas a tax credit is a dollar for dollar offset of the tax that you owe. So tax credits are by far, one of the most valuable things that are out there. And so to if you owe a really high dollar amount in taxes, but yet you've been able to generate a certain amount of credits to be able to offset that, then, you could theoretically get back to zero again. So now, that's always the goal. And back to the investor status and being in, thinking back to Kiyosaki's, cash flow quadrant, like that investor quadrant is the best quadrant to be in, because then you have passive cash flow, zero taxes, and the ability to be able to offset any kind of income that you have. So, being that investor is the most important piece of it, right? And I think a lot of business owners are trying to, being a business owner myself, right? You get into business and you think, okay, I'm really good at this, so I could probably just go make a lot of money if I go do this on my own, right? But then what you don't realize is that most of the time, all you're doing is you're trading a job for another job, and that new job has a lot more responsibility to it and a lot more, unless you're, closing, making sales or doing the work or doing all those different pieces, you're not getting that paycheck whenever you come around. So I think the opportunity for a lot of entrepreneurs and a lot of business owners is to actually take their business, become an investor in their own business, because that's the asset class that they have the most knowledge of, the most awareness of, the most control over. And then you can take that, turn that into a passive investment also by getting yourself out of the day-to-day. Now you have a passive income generator, and you can go out and create, additional passive income streams and, really get into that I quadrant in Kiyosaki's cash flow quadrant.
Yeah, I love that strategy. Can you give us any examples on tax credits?
Yeah, so, a really good example. From a real estate perspective, historic tax credits are probably one of the ones to see and actually have clients that are doing. So, identify older buildings in areas that, some buildings that have some kind of historical significance to it, right? So you go in, renovate that building, bring it back up to par, do what you need to do. And then there's tax credits that are associated with you doing that. And so there's a certain amount of, the expenditures that you had to rehab that building then qualify for the tax credit. And then, you could use that tax credit, the tax credit can be syndicated. There's all kinds of different opportunities and options that are out there. But, I think probably low income, historical are probably the two biggest from a real estate perspective.
Yeah. Aaron, one of the areas we see a lot of folks also have some basically low-hanging fruit to do some, financial engineering right in their portfolio is having trapped equity in their primary residence or in, a real estate portfolio, right, where they're kind of paying down the bank debt. So do you have any thoughts in terms of, strategy around, does it make sense to manage to a certain LTV or to be trying to capture some of that trapped equity in a residence and then increase basically your mortgage interest deduction if you have that, try to now reinvest that in other assets?
Yeah, absolutely. So, I mean, because trapped equity is a really good phrase for it because it's essentially dead money, right? I mean, like it's liquidity that you could have access to that you could use towards other opportunities, other investments, especially your primary, right? I mean, primary doesn't produce any kind of cash flow to it, right? So if you're sitting on a bunch of equity within your primary home, it's a really good opportunity to maybe utilize some of that. Even at today's higher interest rates, many times, I mean, the yields that you could, get, especially if on a rental property or another, some of the rental portfolio, you can earn more than even the interest that you would pay on your home equity line of credit. And like you had said before, I mean, that then creates a deduction, right? So, there's having trapped equity inside of real estate is always a challenge because it's not being fully utilized, right? And that's why the BRRRR technique in real estate is one of my favorite techniques, right? Because then, you're acquiring properties and you're making sure that whatever you're buying it for, plus the money that you put into it, is less than what you could potentially refinance back out again, right? So then you get done with the rehab, you go back, you refinance that property, pull all the cash back out. Now you have no equity tied up inside of there, right? So no leftover investment. Take that same cash, go buy the next property, do it again. And it's by far the fastest way to be able to build your rental portfolio is by using that cash flow, or velocity of money, I think is probably the best phrase for it.
Yeah. Yeah, makes sense. We're about to take in a new administration into the White House. The campaign is officially over, and so we have a new administration coming in. And do you have any thoughts to make the audience aware of things we need to be looking for? What might be happening with bonus depreciation with this type of administration, or any other, key areas that would be relevant to this audience?
Yeah, absolutely. So I'm really, really watching, because I think in the first, I don't know, maybe 3, 4, 5, 6 months, I think we should have a whole lot more clarity around what's going to have the more specific clarity. I think there's, general talk around bringing 100% bonus depreciation back. I mean, that was already in a bill that passed, and it's just been sitting out there for, I don't know, maybe a year. It's just been kind of hanging out there. There's so many things with the expiration, that are expiring that, between the gift tax exclusion and bonus depreciation and tax rates and all these kind of things that are expiring relatively soon, that with the new administration plus both sides of Congress, I think will create a little less friction, maybe is the best way to put it. And in updating, renewing, getting some of these things right. One of the biggest things I'm watching right now is, I've heard corporate tax rates maybe going down to 15%. And I think corporate tax rates at 15% would be a game changer from a planning standpoint, because C corporations were used, like we use C corporations occasionally, but definitely in a scenario where we have a high tax bracket and there's not a lot of things we can do to be able to fight that high tax bracket. Then we can incorporate another entity that is a C corp in there, to kind of cap that tax rate. So now if we can actually utilize a C corporation and cap that tax rate at 15%, that opens up a whole new world of opportunities too. So I think it'll be really interesting to see what happens over the next, 4, 5, 6 months. Definitely something I'm watching, paying attention to them to see if there's something that comes out of that we can actually utilize from a planning standpoint.
Yeah, 100%. And what about things to, watch out for? I've heard, words of people looking for, the IRS kind of cracking down on, land easements, things like that were kind of less in favor. Actually, I've heard about real estate professional being even kind of cracked down on more these days. Are there any kind of items like that, we should be aware of?
Yeah, I would say Captive micro insurance might be another one in addition to the conservation easements. I have seen some clients that have done conservation easements. It's come back to bite them. It was before we were working together. It has come back to bite them. So that's definitely, and I think the prior administration and I guess the IRS, they created this dirty dozen list, right, of all these different things that they were definitely going to crack down and watch for more often. I think, micro, captive insurance, conservation easements are probably the two of the biggest ones that I've seen that really fit for a lot of clients from a pure technical standpoint. They actually make sense, and if they're done correctly, the way that the rules are written, there's nothing wrong with them. It's that you have a lot of times bad actors, maybe is a good way to put it. People that are out there and they get this great idea and they start promoting it a little bit more, and they turn it a little bit more into a planning sales pitch, I guess, maybe, as opposed to anything else.
Yeah.
And I think from a real estate professional status, it's definitely something that I've heard that they were looking at a little bit more. But I think that goes back to the documentation aspect of things, right? So whenever you take a tax position, you always want to be comfortable in that position. And you want to be comfortable from that planning aspect that we can, we have the support, the documents, the data, to be able to actually take this position and be comfortable with it. So I think you can do anything that the tax law says, but you just have to make sure that you have the right facts in place and the right documentation and the right pieces aligned to be able to take that position and be comfortable with that position.
Yeah, sage advice there. If you could give just one piece of advice to the audience about how they could accelerate their own wealth trajectory, what would it be? Yeah,
I would say probably the biggest thing is bet on yourself, right? I mean, to take control of your own future. We talked a little bit about 401ks and Wall Street and traditional investments and how those, are good or, bad. But I think if you take control over your own destiny, plot out, create that future vision, create that plan, create that game plan that gets you to that, and then educate yourself, surround yourself with the right team members, and do the things that you need to do, not only on a yearly, quarterly, monthly, weekly, daily basis, but then, just do whatever you can each day to kind of move that needle forward. But if you have control over your own situation, your own destiny, by betting on yourself, you're gonna be more successful, I think, later on down the road.
Love it, for sure. Aaron, it's really been an honor and pleasure to have you on the show. Really appreciate your expertise. And, I guess I would leave the audience, out there with this thought too. Now it's January and people aren't really thinking about, all they're thinking about is filing their taxes. Right. But it's probably one of the best times that you could actually start a strategy if you don't have a strategy, so that you have the full, 12 months to actually work on it, rather than waiting till the end of the year and then trying to get, forced into some kind of situation. So making sure that you have a strategic, tax planner on your team is just absolutely critical to your success. So I really appreciate you, sharing your wisdom and expertise, because again, all CPAs don't think this way. And it really takes kind of getting an understanding of that and then building that, key relationship out, on your team, on your wealth team, to be able to do that. So if people want to reach out and learn more about your company, what you guys are doing, what is the best place?
Yeah, so probably best places I've started our website, has a little bit, information about us. And I think, maybe links in the show notes, or upstream.cpa, is our website. LinkedIn, another good way to connect. So I think those are probably the two best ways.
Okay. Yeah. We'll make sure to link that in the show notes for anyone who's driving out there. And again, thanks for coming in, Aaron. Appreciate it.
Thank you. Appreciate it.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.